Hello and welcome back for another edition of London Direct. Akshay Kapoor from Gekko Global Markets was uber bearish on 2013, but the market certainly didn't move in his favour. So does he have any more outrageous predictions? Well, it's time to find out. Well, Akshay, I come to see you at fairly regular intervals, say every 6 months or so. I wouldn't say famously, but previously you said that there was going to be a big tick down in the stock markets at the beginning of last year. But before we talk about the markets and how they're going to move, I just want to talk about the academic arguments, because you, like other people, were saying that these extraordinary measures by central banks was a disaster, and we haven't seen that. We also haven't seen hyperinflation, which many people were predicting as well. So why are we in this position where we're seeing not even high inflation, but slowing inflation in many parts of the world?
Right. So in the context of these aggressive monetary policies being a disaster, I was thinking of them as a disaster from the point of view of an individual. Yeah. If you are a middle-class American or a middle-class Briton, then they have been a disaster for you, because they have led to a massive increase in prices of your daily food, in prices of your fuel, in your cost of living. There was a very interesting survey out from Gallup in the US, which says that about 52% of Americans own stocks. Yeah? And out of that 52%, only 5% own 75% of all financial assets. So for the other 95%, it has been a disaster, because financial assets have become very expensive, real assets have become very expensive, and cost of living has gone up because your labor has been devalued. Right? You work hard, you save money, the value of that money has gone down. So it's been a disaster for those people. Quality of life has definitely gone down. In terms of hyperinflation, I don't think I ever talked about hyperinflation in the near term, but I think hyperinflation is usually always a political phenomenon. So a necessary condition for hyperinflation is a lot of monetary easing, but a sufficient condition is some kind of war or some kind of political dislocation. So we've not really had political dislocation till now, but if monetary easing at this rate continues for a very long time, I think you will certainly have conditions for significant inflation. That will certainly happen. But
why are we seeing such low levels of inflation in Europe and also in the US, this term disinflation?
You like an easy fix, don't you?
Well, no, but
give it some time. See, these things take time, right? We're talking about the whole economy. We are talking about 8 billion people on the planet taking their decisions on a day-to-day basis, the complex interactions between everything. These things take time. So in a scenario where you didn't have massive undercapacity, you don't expect immediate hyperinflation. I don't think anybody talked about that. People certainly talked about the decreasing value of money. People talked about a transfer of wealth from the middle classes and the lower classes to the highly wealthy. So people talked a lot about concentration of wealth. A lot of concentration of wealth has happened. So all of that has happened. But hyperinflation or massive inflation and stagflation will certainly come in if these policies continue for, say, another 5, 6 years, 10 years. Sure, that will certainly happen. I have no doubt in my mind. But hyperinflation, I think, is a tricky one. The high inflation will certainly happen. It'll just take a bit of time.
Okay, well, let's move on to the market impacts. Last year you were expecting a big decrease in the S&P 500. It went the opposite direction. So where do we go here after we've had such an up 12 months? Do you think that the equities have the legs to climb further?
So let's agree that I've at least got half the thing right. So I got 30% right.
Yeah, just the wrong direction.
Just the wrong direction. At least I got half of that right. And I'm probably one of the very few ones who openly admitted that. See, I thought the S&P was overvalued last year. I think it's even more overvalued now. I think what I thought last year was that rationality might prevail and markets might correct, and that's clearly not happened. I think it was still a very, very bad risk last year that played out very well. So I still would not have invested money last year. It's a very bad risk. But it just so happened that the roll of the dice worked in the favor of the speculators. It played out very well. I still think that the S&P is grossly overvalued. Actually, I've got jotted down a few things. Let me see if I can find them for you. A little post-it note. So what I've done is over the weekend, I was just having a drink with a friend. We were talking about these things. And just as an exercise, I calculated the average S&P EPS for the last 6 decades, right? So the S&P is at, let's say, roughly about 1850 right now. Forward earnings expected at about 120. So we're talking about a PE ratio of about 15, forward PE ratio of 15, roughly. So let's see what average EPS on the S&P was for various decades. So the decade of the 70s, what do you reckon the average EPS was?
I can see your paper, so I'll be cheating. No, Corin, you tell me.
37.5, the decade of the 70s. Volatility was 4.68. This is the average, yeah? The decade of the 80s, it was 35.62. Volatility was 5.17. The decade of the 90s, it was 45.93. Volatility was 13. The 2000s, so the first decade of the century, EPS was 58. Volatility was 24%. Right? So if you see, EPS on a decadal basis, at most has grown by about 25 to 30% over 4 decades. At most. Even if we say that it's going to grow by 30-40% between 2000 and 2010, for the decade for this decade, you should not have more than 90 EPS, max, right? We've already had three or 4 years of EPSs around that much, and last year higher than that, yeah. Now at 90 EPS, to justify this valuation, you need a 20 PE ratio, right? And you've already seen 90 EPS for the first three years of the decade. So the chances are that this is going to mean revert. This is going to go down. And this ties in very well with the fact that corporate profits are grossly, overvalued is a wrong word, but corporate profits are significantly above their average. As a corporate profits now are 12% of GDP. Typically they're about 6% of GDP. Margins are 70% above their long-term averages. These things will mean revert. If not this year, if not next year, then the year after. This will mean revert. I am willing to bet anything on this, right? Just another very interesting point. Look at volatility. Decade of the 70s, volatility was about 4.68%. Decade of the 80s, volatility was 5.17%. Decade of the 90s, volatility was 13%. Decade of the 2000s, volatility was 24%. So as you're seeing, as more and more intervention is happening, volatility is increasing. Mm-hmm. You will see massive. You will see a big crash either this year or next year. It is bound to happen.
Well, thanks to Akshay for speaking to us so openly. Stay tuned to Dukascopy TV for more interviews. But from London, goodbye for now.